A capital asset is anything purchased for income, business, or investment. A capital gain is any profit earned when a capital asset is sold. The primary residence is held for 24 months out of the last 5 years. First, if you're married, filing jointly,
Up to $500,000 of gain is exempt.
if you're filing individually, up to $250,000 is exempt. If a vacation home is rented for fewer than 15 days each year, it is considered to be a second home, and the 15 days or more is considered to be an income-producing property. The significance of that is that if it's an income-producing property, there are expenses you can write off. If it's a second home, you can't. Residential income properties depreciate over a 27.5-year period, whereas non-residential real estate properties depreciate over 39 years. The basis for depreciation is your purchase price plus closing cost times whatever percent of the building value. Remember, we're only depreciating the building. So if the building is 80% to the land's 20%, it's only the 80% of the building that's depreciating. After-tax cash flow is calculated by potential gross income minus vacancy and collection losses. And by the way, after that, we're going to add in any other income that might be coming in, such as vending machines. Vending machines and those kinds of things you don't take vacancy against. That should give us effective gross income. From effective gross income, we're going to subtract out all of our operating expenses. That'll give us net operating income. From net income, we're going to subtract out our annual debt service or our annual mortgage payment. That'll give us before-tax cash flow, also known as cash throw-off. From there, we subtract out our income taxes, and that gives us after-tax cash flow. The installment sale is seller financing that will allow the seller to take gain over time, which may reduce their tax bracket. The tax-deferred exchange is like-kind properties, and remember that's anything that we buy for income, business, or investment, and your primary resident is not considered as part of an exchangeable item, as is dealer inventory. Boot can be cash or other unlike items, such as the difference in mortgages, and those are not exchangeable, and you pay taxes on the boot in the year that you do the exchange. Also remember that in an exchange you have to have a qualified mediator who has to handle the exchange, and all you're doing with the tax-deferred exchange, it's not tax-free, you're simply postponing it to a later date. And that's all we have for Chapter 14 summary.